If you've got a house and you've got a mortgage, you're probably thinking, what do I do with this mortgage? How do I set it up, right? I know that I've got the option of having fixed loans. I've got the option of having floating loans. I've even got the option of having interest-only loans. How to set it up. If you don't know how to play this game and how to set up your mortgage with the best options for you for fixed, floating or interest-only, then it's likely that your mortgage is not set up as great as it could be. All right, so this video we're going to talk about understanding these different products and how you can use them to your advantage. So before we carry on, let me just introduce myself. My name is Jeff Elias. I'm the founder of Futurebound, where we help people to get mortgage and financially free. Okay, let's crack on. So I'm going to cover off the easiest one first, interest only. Okay, now there's really only one situation that I believe that you should have interest only on the house that you're living in. Okay, the only reason that you should have interest only is because you are in a really tight financial situation. Okay, like you're under financial duress, and this means that you're going to go to interest only, which with pretty much all New Zealand banks you can only have for 1 or 2 years. It's quite a limited time thing. You can't have it forever. Okay, but if you're really under financial duress, then you can request interest only, or you can even get interest only at the start of your mortgage. But if you're having to get interest only at the very beginning of your mortgage, it probably means that your mortgage is too big for you. Okay, and you're going to struggle to meet repayments, because remember, you can't have interest only forever. It is going to go to principal and interest, and banks really discourage having interest only on the house that you live in. So this is really, I'd probably say, ideally, you're not going to do this at all, and it's really only if you're in tough financial situations, and if you're buying a house for the first time and you're having to go interest only, it probably means the mortgage is too big and you shouldn't be buying that house. Okay, that's interest only. Let's talk a little bit now about fixed and floating. All right. Now, what do we love about fixed? What we love about fixed is certainty. All right. So with certainty, you can fix with fixed loans, you get that certainty because you can fix it for 1 year or 2 years or 3 years, and you know exactly what your repayments are going to be for that period of time. You get certainty. All right. That's great. Now, what's the negative side of fixed rates? You probably can't, it was difficult to pay that loan off faster should you get pay increases, or should you come into some money and you want to throw it at the mortgage. If it's fixed, you might not be able to pay it off faster. For the floating loan, however, you can pay it off as fast as you want. When it's on the floating rate, you can throw money at it every day if you want to. You can pay it down as fast as you want, no penalties involved. The only negative of being on a floating loan is that it's a higher interest rate, right? So in New Zealand, floating rates are higher and fixed loans are lower. Pretty much nearly all the time this is the case. And so if you're going to put your whole mortgage on floating, then true, you can pay it off as fast as you want, but you're going to pay a higher interest rate as you're going along. So what's the best of both worlds? Well, the best of both worlds is that you could do a bit of both. Okay, so you could say, like, I know that I can pay $20,000 off my mortgage off over the next year. Okay, and that might mean you choose to have $20,000 of your mortgage on floating. Okay, because that's all you really need, because you're going to do some maths at the beginning and figure out how much extra can I come up with this year. Okay, and we're not going to count on winning lotto or getting inheritances, because you don't know if that's going to happen or when that's going to happen. So you're going to count on, how much money can I get this year? And if you know that, for example, I can come up with an extra 20 grand, then you might choose to put 20 grand on floating. Throw that cash at it as fast as you want. Okay, and then the rest of the mortgage, you'd probably want to put it on fixed to give you some certainty. Now, if you believe rates are going to be coming down in the near future, then you don't want to be fixing for 3, 4 or 5 years, right? But if you think that rates are going to be going up in the future and there's good rates now, then you might want to fix for longer. Okay, so this is where you can mess around and you can split your mortgage into multiple loans. You can put, some of it on 1 year fixed and some of it on 3 year fixed. You can do different things like that if you want to, according to what you believe interest rates are going to do in the future. And just use those different loans to manage your risk. I hope that you found this video helpful. If you've got a mortgage, maybe you've just bought a house and you're wanting to get some advice or some help around how you structure your mortgage, or maybe you've even had a mortgage for a long time and you know that you don't really know what you're doing with it, then I invite you to get in touch, book a 15-minute chat with one of the Futurebound team. We can have a look at your situation and look to give you a little bit more certainty and a bit more strategy and a bit more structure around your situation, so that you can feel really good and confident about your mortgage going forward. looking forward to catching up.
For more financial tips, advice, and education, subscribe to us on YouTube and don't forget to hit that notification bell.